Hello and welcome to this month's episode of Capital Markets View. We've made it through to December um, and we're still doing Capital Markets View. Hey Taryn, how are you?
We're still at home,
Yeah,
not back in the office.
no, I know. Vaccine rollout, so the end is in sight, which is different from lockdown one. So I think everybody's in a more positive view, even if it is winter. Right, so let's go straight to our first slide, which is new issuance volumes. And I mean, this slide shows, goodness gracious, pretty good volumes, relatively speaking, and also good high yield volumes compared to loans.
Yeah, I think that's probably the main takeaway from this when you look at the big red bars, that high yield is going gangbusters. And looking at December, actually, it looks like we're going to have the busiest December on record, 6.2 billion so far. So it's just overreached 6.1 billion in 2017, which was the previous record. So it looks like everyone's making the most of the good market conditions and the high yield side. Lots of demand, and also demand is strong for FRNs because of the CLO demand. And why is that happening? It's just the vaccine news, I think, turbocharged the risk appetite. A lot of like the Q1 issuers have accelerated into December, and some of the challenge credits that maybe were waiting on the sidelines have said, okay, well, we can go ahead now because there's so much appetite out there for risk.
And if you kind of drill down specifically into high yield bonds, how does it kind of mix between single Bs and double Bs?
So, double Bs still have dominated high yield issuance. Although I did notice, I looked at November, and for some reason in November there was a lot more single B issuance, which goes along with the story of the more challenged credits coming to the market now because demand is really strong. Um, I think with loans, the issuance doesn't look quite as healthy, but it still has been quite healthy in October and
Yeah.
November.
I'm going to
Um,
go to the next slide, slide 3.
yeah,
It puts into perspective for the year. So still
yeah,
relatively more high yield bond issuance, but loans still holding their own.
yeah. I mean, I've been looking at the year end or the year to date figures, looking at the quarter end and year end, and we are still behind, but it still is respectable. But I think, yeah, high yield is still the big story for this year in terms of a lot of issuance. And like we were talking about yesterday, why is this overall? And fallen angels are a big part of it. I spoke with Luke,
Mm.
and he pointed out, this is a really good point, that they have big capital structures and they do large issuance. So that really has contributed to the volume. But it is also the bigger story of quantitative easing, government support, investors going down the credit spectrum, a growing corporate high yield market in Europe, which has been the story for years, as we know, and that continues. So it's really a combination of both of those things.
Okay, so to me, I still fundamentally believe that certainly the leverage loan side of things is mainly single B issuance, mainly private equity firms. I still think sponsors still prefer loans, and so in high yield bonds, you've got, because people have slipped down the credit spectrum to double B. So it's the fallen angels that make up the chunkiest amount of that, and also, of course, demand pull. People,
Yeah.
because of quantitative easing, want demanding more. So, a ranger's going to double B people and going, hey, there's possibilities out there, do it. Okay.
Mhm.
That's fascinating because as I often say, I'm more of a loan person, and I find it fascinating to hear what's happening in the high yield market.
Yeah.
Okay. Shall we pop on to, let's go to slide 4, which is, okay,
Supply demand.
CLO issues. Yeah, supply and demand.
Yeah, so this we actually haven't looked at this chart for a while. We used to show it all the time,
Yeah.
but it shows, just to explain it again for viewers if they haven't seen it for a while. So the blue bar is net supply. So that is new issuance in the loan market minus repayments. So that comes from our ELI index, our European Leveraged Loan Index. So that shows the net supply, new supply in the market. And we're showing that versus CLO issuance. And we do this on a rolling 3-month basis. I think it looks cleaner. It shows the trend better. So you can see in this slide that there's been a gap between the supply and demand, and it's been growing in the last couple of months. So this just shows, obviously it doesn't include all the demand because it's just CLO funds. So there's a lot of other institutional money out there that's not in CLOs, separately managed accounts, other types of loan funds. And so it doesn't include everything, but it's directionally correct. It shows you that there's a lot of demand at the moment. So that is driving issuance in the loan market.
You know what? For a year, which has been, in the global sense of things, absolutely appalling, the CLO market's done pretty well. I read one of your articles about how we're on 20 billion. Of course, last year was 29, but hey, there wasn't a global pandemic going on, so it's doing pretty good. And also, I spoke to, interestingly, this week, end of last week, beginning of this week, I spoke to an arranger and I spoke to a CLO manager. I mean, I speak to plenty of them, but this one CLO manager said, you know what? I think issuance is going to be pretty good next year for both loans and CLOs. And the arranger said, I estimate there are about 30 warehouses out there. And we know new warehouses started opening kind of tail end of summer. Now, of course, both of those constituents are going to talk up their books. They are, of course, they want the market to think everything's going to be great. But I kind of get a good feeling about CLO issuance in the first half of next year, and a reasonably good feeling about loan issuance certainly picking up towards the end of the first quarter next year. I think people have deliberately put off some December issuance, but this shows demand.
Well, you mentioned this yesterday, and I did speak to Michael Ray, who's our CLO journalist, about that 30 number, and he said it is hard to know if that's true. He had heard there were 36 back in November.
Wow.
And so he said it did sound right to him, thinking about the issuance that there's been. About half of them are pre-pandemic and half open since the pandemic. And he confirmed as well that just there is so much competition among arrangers right now to extend new warehouses, and that the terms are back to pre-COVID levels, and that some
Wow.
arrangers are even offering more aggressive ones.
Okay, so that's really good color, and also kind of rhymes with that whole. I mean, I think at the end of last year, people were talking about 40 to 50 warehouses, and it was a bumper year. Well, considering again what's going on, 30 plus 36 warehouses, that's really good for what's happening.
Yeah, and I think you're right about issuance as well. I think there's a lot of pent up LBO private equity money that needs to be spent because valuations are so high at the moment that they don't want to miss this wave. And so there is a lot of pent up demand from the private equity side to do deals.
Yeah, no, I completely agree. Right, let's pop on to slide 5, which is B-rated term loan Bs and spread and yield to maturity. So pricing coming in.
Yes.
And have you noticed, sub 4s happening?
So yes, there are quite a few deals that have been in the 300 with the 300 handle, so 375. And of course, we saw repricing recently from
Yes.
EP. So they repriced from 475 to 400. So I've been talking to people this week, looking ahead to the end of the quarter and first quarter next year, and investors are expecting to see a lot of repricings, a lot more of these to come.
Wow. Okay. So, I mean, and that's a real kind of, bellwether. If you see repricings, the market is pretty healthy. And if you see dividend recaps, the market is pretty healthy. So that shows to me that, things aren't normal, but things are in the market returning to a reasonably good equilibrium for the market, considering what's going on. And also, don't forget, in a context of the first 6 months of next year, and we haven't got any credit condition slides, but in the first 6 months of next year is where we're predicting defaults will grow. So economically, things could get very sticky in the first 6 months of next year, yet the market seems to be shrugging that off. Okay, let's go to slide 6, which is, and here you go. This is the add-ons. So people kind of, and this rhymes with what you were just saying about people opportunistically adding things on because pricing is good.
Yeah, I think, it fits in with that theme, repricings, add-ons. We wrote a piece on this, David wrote it, and he was saying that these are attractive to lenders because they actually can get a discount to where the credits are trading in the secondary market. So that gives them paper for credit that they already are comfortable with, but they're getting a discount. The discounts are probably not going to last that long. He mentions Zentiva's pricing at the end because there was so much demand. The discount got squeezed in the end, and we are seeing OIDs just tightening generally. We're seeing flexes on OIDs. We're seeing pricing margin flexes. So this just all goes back to the story of so much demand out there. Again, driven by the macroeconomic environment and the fact that so much government stimulus. The question is, like you say, about the economic future and how that gets unwound. That's a big question mark.
Yeah, no, it will be interesting. I mean, stock markets are at highs. Governments haven't yet announced measures to deal with the mountains of debt that they're building. Indeed, if they ever do. Okay, let's go on to slide 7, which is returns on the leveraged loan index. There's a nice blue bit.
Yeah, so this is we had a really good month for returns in November. So this was all part of the vaccine rally. So it was a 6-month high. We had a return of 2.8% in the LA. Secondary prices again back up there. So we're actually one point at the end of November. We were 1.3 points away from the high for the year in January. Again, back to demand. But I just like this slide because it shows you the year-to-date returns and the fact that we actually went back into the black in November because of the secondary price movement.
Yeah, and I mean, it basically shows a nice directional journey back to normal.
Yeah. Oh, and the other thing I wanted to point out that I thought was interesting is that this story about investors looking for value and trying to get some of the credits that are sort of trading off. If you look at the top 5 advancers for the month, 2 of them were credits that had been downgraded by S&P ratings on your side of the business, Park Reunidos and Merlin Entertainments. So those were 2 of the ones that traded up for the month. So investors on the loan side as well are looking for value.
Wow. Okay. Wow. Wow. That's interesting to learn too. Okay. And let's go down to slide 8, which is CLO volumes. And we've already talked about how things are pretty good. But I think what I wanted to highlight about this slide is at the moment it's all been new issue. But given where CLO pricing is going, so we just rated Capital 4's new issue up in Denmark. And their AAAs were kind of talked around 105. And people are already making noises about deals that are coming out of their non-call, or another way, and deals that are coming close to the reinvestment period finishing. So you really want to perhaps refinance it. So again, the CLO market kind of reflecting the loan market. If we start to see refis and resets in CLO world, we know that the financial markets are heading back to normal. And then let's go on to slide 9, which is pricing, which reinforces what I was just saying about where AAA pricing is going and how the weighted average cost of capital is coming down. And you guys brought that in a few months ago, well, a little bit longer probably. And I really like that measure because it's not just the AAA pricing that people can get quite obsessed with sometimes, although it's the majority of the stack. But, the stuff lower down the stack and its pricing works as well. And then slide 10. So this slide is quite important because it shows a trend of what's inside CLOs. So this is a percentage of triple Cs inside the CLOs that we rate, and it's a gentle trend downwards. I mean, of course, it went up in April, and then there's a sort of nice gentle sloping downwards to where we are today. Of course, that reflects that actually CLOs on the whole are actively managed, and they have taken advantage of certain points in the secondary market to manage their way out of triple Cs, to buy credits that they like. So they are doing what they should do as an actively managed fund. They're managing their risks. And this graph shows the shrinking of triple Cs in the CLOs that we rate. And we've come to an end. So it's time for our final slide. Yay! So there are our Christmas trees.
Yes. Are we going to say whose, or going to let our viewers guess?
Well, why don't we let people guess whose tree it is? So because we have, so one has candles on, one has lights on. But other than that, they're pretty much the same.
Same. It's a little worrying, Chris. We've been doing this so long. Our Christmas trees are starting to look alike.
Well, even down to the sort of Victorian decor and the cornice. It's not just the trees; it's the houses are looking the same. And I like the colour, which I'm not going to say, which is weird. So firstly, if anyone's got this far listening to us, please look at the email that you get with this, because there will be some links to some research. Secondly, I encourage you and everybody else to listen to us in January, because of course in January it will be the whole year's stats, and Taryn and I will be able to do a comparison and a contrast about the entire year. And thirdly, thank you to everybody who's watched this. Happy Christmas, happy Hanukkah, happy holidays. Taryn, I mean, I'm at home, you're at home?
Yep, we're at home. Yes, and thank you to all of our viewers for keeping watching us this year, and all the best to you and your families.
Yep, stay safe. Happy Christmas, happy New Year. And as ever, any questions, feel free to give Taryn or me a call. Thank you.